So, for the reconstitution of partnership firm, you have to find out new P&L ratio, and you have to handle the case of goodwill. We have completed number 1 already. In this class, we'll start with goodwill. So, goodwill is nothing but the reputation of your company is measured in terms of money. Measured in terms of money. The reputation also, for the accounting terminology, will be called as earning power of the company, future maintainable profit. And at what time we go for valuing the goodwill? When you are supposed to change PSR, admission, retirement, sale, and amalgamation, death of partner, in all these cases, goodwill is to be calculated. Now, you have to understand three aspects here. Goodwill. First of all, you have to understand what is goodwill. What is goodwill? Reputation of the business measured in terms of money based on the future maintainable profit. Okay, if the company is able to maintain good profit in the future because of their past years committed performances, this company's value may be higher than the other company. Because of that, they can earn good money in the later, means we need to value for the extra earning power in the later period due to their reputation, which is called goodwill. And the goodwill may be of what? Why do we get the goodwill? Reasons behind. Maybe our business is in the prominent location. Our size matters. Okay, the optimum size, so that we are able to produce at a much cheaper rate and we can sell at much higher rate, premium rate. And we may have some patent for our production that others will not have. We have some technical know-how that others will not have. Because of that reason, I'm able to earn good money. And some key persons we have in our business, and sometimes market situations also, etc. These are the reasons we have. So based on the reasons, your company has some extra earning power. Now, based on the extra earning power, you can then value the goodwill. That is what about the second one, valuation of goodwill. Goodwill will be valued under simple average price method, profit method, weighted average profit method. Even we have super profit method and capitalization of the profit method, annuity method. So these are the 5 methods we have for calculating the goodwill. So as we know that the company has extra earnability because of these are the reasons, or some other reasons also not listed here. And while selling my business, I'll sell not only the assets and liabilities what I have, I need to demand some extra money for the extra earnability because of these extra flavors we have that others will not have. Clear? So that will be the called reason. So because of that reason, if you are able to earn extra, means what is the value you are going to fix for that extra earnability? That may be determined based on one of the 5 methods we have given here. Valuation, simple average price profit method, weighted average profit method, super profit method, capitalization method, and annuity method. So we will try to understand first of all the methods one after one. Finally, how are going to be recorded in our books accounting of the goodwill calculated? Okay, accounting of the goodwill calculated. Under this one, we have premium method predominant. Premium method predominant. Though it may be premium method, we may have sometimes cash model, means the cash may be brought in by the incoming partner for the goodwill. Or if I plan to sell the business and then buyer offer some money for the goodwill also rather than not offering. So that's called cash method. Non-cash method. Non-cash method means he will not allow to bring any cash for the goodwill, but only he brings the cash for the capital, but goodwill is somehow it's going to be adjusted, so we'll study that separately. In another case, we have the combination of this cash as well as non-cash. So these are the 3 methods. If you are able to understand these 3 methods, then accounting is comfortable. So the valuation under 5 methods are very, very easiest one. So we'll try to finish off all these things logically, not just like a formula here, right? Let's start with the first question. Okay, calculation of goodwill. and accounting treatment. Accounting treatment. We'll see that accounting treatment first of all later on. In this particular illustration, we will be trying to find out the goodwill under simple average method and weighted average method. Calculate goodwill under 2 years purchase of 3 years simple average profit. So goodwill is equal to 2 years purchase of 3 years simple average profit method, or sometimes rather than simple average profit method we may use weighted average profit method also. Now what about the 3 years simple average profits are? You will give the value for or a consideration for the goodwill based on the company's future earnability, not the past earnability. In the previous 7 or 8 years, the business gave good profit, but in the coming years, we don't expect such a profit, or the profit will be very, very lesser. Very, very lesser. What will be your reaction then? Sir, business is not doing well. How can you expect me to pay some extra money for the goodwill? So I will not be paying anything. So from this, it is very clear the goodwill is calculated based on the company's future earnability, not the past earnability. How can we determine the future earnability? It's only estimation, right? How can you estimate? You might have studied in your stats, regression analysis, scatter diagram and all. Is that okay? Regression line. Okay, but in simple sense, average of the past years may be a future's expected profit. Last 3 years, sir, every year we made a profit of rupees, say 10,000, 10,000, 10,000. From this, it's very clear. The next year also we can expect 10,000. In the last 3 years, 10,000, 12,000, 14,000 were the profits. So gradually it is increasing, 10, 12, 14. The next year we can expect at least 14 or 15,000 rupees. So from this, it is very clear to determine the future maintainable profit, we can use the past year's profit. So the past 3 years simple average profit is the indication of your future maintainable profit. Clear? Now what's the next step? What is the 2 years purchase, sir? What is 2 years purchase? Why the company can earn higher than the other company? Company X makes a profit better than company Y. What may be the reasons? There may be few reasons, right? So already listed here. What are the reasons? Maybe because that business is in prominent locations, sir, and they have the patent, they have the technical know that others will not have, and the key person who is leading the business, in his absence, the profit will go off. So these are the reasons. Because of that, this company earns better than the other company. This company earns better than the other company. Is that clear? Now, location, matter of 4 years or 5 years, we have to vacate as per the contract. Key person, matter of 3 years or 4 years, he may retire. And patent may expire matter of 5 years later. 5 years later, anybody can manufacture. My patent will be lapsed. So earning power is based on these things, means how many years these things will be favorable for you. Only a limited period. Am I right? So if you say that, what? Sir, I'm able to earn around 10,000 rupees in the future based on the previous year experiences we found out. This is called future maintainable profit. Now, why do I earn this 10,000 rupees extra? Because of the location advantage, key persons, patent. Now, how long all these things will be favorable for me? Sir, only for 3 years, sir. Only for 3 years. This is called period of maintainability of such profitability. Then what could be the goodwill? My company gives 10,000 rupees extra than the other company now next year due to these reasons, and these reasons will be with me for at least 3 years. So 30,000 rupees you can earn extra because of my extra advantage we have over the others. Then pay me, apart from the assets, you need to pay another 30,000 rupees for this image. This is called goodwill. So this 3 is represents what about? Period of maintainability. This 10,000 is nothing but future earning power. If you expect some money for these two values, then it is called goodwill. This is called goodwill. Hope you will be now able to understand. Clear? Clear? Similarly, in this illustration, I'll start with calculate goodwill under 2 years purchase. So here 2 years is the matter. of 3 years simple average profit method. So we have to use what method? Simple average profit method. Then this is called goodwill. Another method, you can use weighted average method also, weighted average price method also. Okay, now year, these are the year 2017, 18, 18, 19, 19, 20 year. What about the profit here? Okay, 6,000, 8,000, 10,000. What is the average profit? What is the average profit? Total divided by number of years. So 8,000 rupees. Simple average profit. Simple average profit. Now goodwill under this model. Period of maintainability. How many years this extra earnability can be maintained? For 2 years. So what about the goodwill? You have to multiply with the simple average profit is multiplied with the number of years of maintainability. So 16,000 is the goodwill. Clear? 16,000 is the goodwill. Any doubts here? Now tell me, if you are being the seller, will you be happy if the buyer gives you 16,000 rupees for the goodwill? Will you be happy or not? 2, 6, 8, 10 gradually increases by 2,000 rupees every year in the previous 3 years. And seller says, sir, average is 8,000 rupees for the 3 years. It is, sir, for 2 years it's 16. What will be your reaction, sir? No. 3 years ago 6, 2 years ago 8, last year it's 10. Gradually increasing. Definitely in the incoming year, minimum 10 or 11 should be there, right? That's how you will argue. How can you consider the earliest profit for your goodwill calculation, sir? I don't accept this. Then automatically what happens? So one more model comes, which is called simple weighted average profit. Under weighted average profit, you have to give the weightages. While giving the weightage, you have to give more weightage to the latest profit. Okay, if you score first rank in your college, so that will be a good reason to join CA and CMA. You can clear the examination in single shot because you have done better job. Rather than that, you scored last rank in university exams and first rank in your LKG exams, stating that, sir, I got first mark and first class, so definitely I will pass the CA and CMA. Will it be possible? No. Oldest performance will not reflect the future. The immediate performance only reflects the future. So among the 3 profit, which is the immediate profit or latest profit, 1920 is the latest profit. Give more weightage to that profit and least weightage to the old results. 3 years means we assume the maximum weightage being 3 if the weightage is not given. So I give 3 weightage for the latest profit. One after one, I am gradually reducing this to 1 like. In case 4 years means the 4 will be given to the latest profit and gradually decrease to 3, 2, 1 for the oldest one. In sometimes, no, in question itself, they may give weightage for the latest profit being 5 and earlier it is 3 and it is 1. If weightage is given in question, then no need to worry about that. Take that weightage as it is. If the weightage is missing, then number of years will be considered as the highest weightage applicable for the latest profits and gradually reduce 1 by 1 for the oldest profit. This is weightage. Now, summation of weightage being 6. Come on, find out the weighted profit. You have to multiply the profit with weight. So, first year 6,000 into 1, 6,000. Second year 8,000 into 2, 16,000. And third year 10,000 into 3, 30,000. What is the final value? 52,000. Now you have to divide this by weight. Okay, weight. So what is ultimate value? Weighted average profit being 8,667. The period of maintainability here being 2 years. And what about the goodwill here? 17,334. This seems to be logically better. So from this, it is very clear we may be given 2 methods of goodwill calculation. Either it may be simple average method or weighted average method. And what method to be chosen, sir? In your question, if it is stated clearly, no problem. If it is not stated, okay, what method can be chosen? If the profit shows a trend like 10, 12, 14, definitely in the incoming year it should be 14 plus. Else, if it shows 8, 6, 4, like every year it is reducing, then future this value will be less than 4. So if the income in the past year shows a trend, then give more weightage to the latest profit. So here latest profit will have more weightage. So in case of trend, you can have weighted average profit method. In case of simple average profit, if we don't have the trend, then we can use simple average profits. Okay, you can use simple average profit. Any doubts here? So simple average price method, profit method is useful if there is no trend. Weighted average method will be used if the profit has trend. Clear? That's a simple logic. Come on, make a note of it. So with that, the question number 1 is over. We'll move on to the next one. Make it faster. Okay. When did you join? எப்போ ஜாயின் பண்ணீங்க கிளாஸ்? அப்படியா? எவ்வளோ லேட்டாக வருது? ஓகே, make it faster, make it faster. Are you able to understand the logics? Shall we move on to the next one? Come on. Online students, respond me. Now, we'll now deal with super profit method, capitalization method, and annuity method. Under super profit method, profit method, we never calculate what? We never calculate based on the actual future profit. Okay. For example, in the earlier case, we found out the future maintainable profit being 10,000. Either it may be simple average method or weighted average method, whatever it may be. But if you want to start a business with an investment, for that investment, that business should generate some income, right? Probably for that, this business generates around 6,000 rupees profit default. So now, this is the normal profit you can expect. NP, I may name this being the NP, net profit. Future maintainable profit calculated based on simple average profit and weighted average profit method. Weighted average profit method. One of the two methods can be followed. But for every investment, we can fetch some income. How will you expect me to pay for the entire 10,000 rupees? If I invest 1 lakh somewhere, I can earn at least 6,000 rupees if it is being the new business. As it is the reputed business, I am able to earn 10,000 rupees. In case of non-reputed business, I can earn 6,000 rupees. In case of reputed business, I can earn 10,000 rupees. If you demand for any payment for goodwill, demand any payment for any goodwill, I may be willing to pay for the extra earning power of yours. What is your extra earning power? 4,000. Only this 4,000 is considered as your earning power, and based on that only I will pay you goodwill. Then this is called super profit. Very simple. It is not based on the complete future profit. It's based on extra earning power of use. Extra earning power means what's the profit you can earn minus what the profit we can normally generate it for similar business if I start fresh. Is that okay? So I'll give this as a formula. Future maintainable profit, otherwise actual profit expected, minus normal profit. Normal profit in this case is nothing but what amount you invested, capital employed multiplied with the normal return you expect. Okay, normal return, otherwise normal rate of return, NRR. Okay, if I invest 1 lakh rupees, you can expect around 7%. 1 lakh into 7%, 7,000 rupees you can generate. If your company is capable of earning beyond that, only your company is having the goodwill. Otherwise, the company has no goodwill at all. That's how we'll do. The difference between these two is the super profit. And based on the number of years of purchase, you can find out the goodwill easily. Clear? This is super profit method. Sachin Ganguly are partners of a firm SG and Company. From the following information, calculate the value of the goodwill by super profit method and capitalization method. So we have two methods. Let me finish up the super profit method first of all. The average capital employed in this business being 5 lakhs. You have invested 5 lakhs rupees. The net trading profit of the firm for the last 3 years being 150, 170, 190. Then you can find out the future maintainable profit. How? As the previous 3 years profit shows um, a trend. So you can use the weighted average profit also, or you can go with the simple average profit. You can assume yourself, right? The good logic is applying what? Um, Weight will be more logical. But anyhow, I don't apply the weight here. As I solve this without weight in the book, I go with that. 150, 170, 190 by 3. So the average profit is going to be expected in the future period being 1,70,000. The rate of return expected from the capital having regard to risk involved at the rate of 15% per annum. 15%. Similar nature business, similar nature business where you will be getting around 15% return on your investment. So if I invest 5 lakhs in a business, around 15% I can expect as a return means 5 lakhs into 15, 75,000 I can earn in general. That is called normal profit. But this business will give you 1,70,000 rupees, almost 1,05,000 rupees you can earn extra because of the company's reputation. If you want to start new business for the 5 lakhs rupees of investment, you can earn 75,000 rupees. If you buy my business, you can earn around 1,70,000 rupees rather than 75,000. How much you can earn extra? 95,000, right? Okay, sorry, this is 95,000. You can earn around 95,000 excess. How many years I can earn this 95,000 excess? Goodwill to be valid for 2 years purchase. We can expect this extra earnability for 2 more years. Then what is the goodwill here? 1,90,000. Hope now we'll be able to understand the goodwill calculation. Don't simply memorize the future profit minus normal profit divided by as a multiply with the number of years of purchase. That's not the logic, but understand why do we calculate all these things. In your school days, you might have studied that the goodwill seems to be one of the easiest chapters, right? You can score around 4 marks and 5 marks. How many of you know that this chapter is one of the complicated chapters where even at final level, this goodwill calculation carries 16 marks question or 20 marks question nowadays also. This goodwill calculation has around 16 to 20 marks also in your examination. Yes, come on, make a note of it. Let's move on to the next one. Now I'm going to solve this under capitalization method. Now, under capitalization method, what I'm going to do? Under capitalization method. Okay. Under capitalization method, capital required to earn that super profit is the goodwill. Capital required to earn super profit. For example, for 5 lakhs rupees, 15% is the earning, then your normal profit is equal to what? 75,000. Capital employed into normal rate of return. Is that okay? That's how we'll calculate. Now, capital employed for super profit is going to be calculated. That's all. So for earning 75,000 rupees, you need 5 lakhs rupees investment at the rate of 15%. For earning 1,90,000 rupees, how much capital employed is required? Where your normal capacity to earn being 15%. Super profit, no? Super profit is 95,000. How much is that? 15%. Otherwise 0.15. Otherwise, capital employed is equal to 95,000 divided by 15%. Come on, get me the value. 6 lakhs. Okay, 33,333. Otherwise, the formula is pretty simple. Goodwill is nothing but this one, named differently. That's all. So capital required for earning this super profit is the goodwill. So the formula here being goodwill is equivalent to super profit divided by normal rate of return. Or you can calculate this way: goodwill is equivalent to actual profit, or actual means future maintainable profit you earn divided by normal rate of return. From there, you have to subtract the capital employed. This way also you can calculate. In both the way, you will get the same answer. In both the way, you will get the same answer. You can try it yourself. So capital required to earn that additional profit, that super profit, will be um, considered as goodwill in this case. Now, let's move on to the next one. If it is clear, text me. Online students keep texting me. So I'm getting the message only from very few. ST Mini, Akshaya, Gayatri, Darshika, Srimadi. Make it faster. Yeah. Now, finally, we have annuity method. Annuity method. We assume the number of years that we will be enjoying the benefit is 3 years. 3 years. Okay. What happens here? Sir, in the coming years, I can get 95,000 excess income for year 1, year 2, year 3. 3 years I can earn. If I'm able to get 95,000 rupees every year extra for the 3 years, what could be the goodwill under super profit method? So you multiply 95,000 into 3. What's the value? Okay. 2 lakhs 85,000. If the buyer demands, sir, you are able to earn 95,000 rupees extra every year for the 3 years, give me the 3 years earnability, extra earnability because of my own reputation in cash to me. That's called goodwill. But buyer says, sir, I'm able to earn the 95,000 only by the end of first year, second year, and third year, not today. What happens to the interest component, sir? Okay, if I have 90,000 rupees with the 10% rate of interest, it becomes 99,000 rupees by the end of first year. But 1 year later, you are getting 95,000. You are demanding to pay that today itself. How can I pay? That's a discounting concept, right? Interest component is there, so you have to remove the interest component. So in your costing, I mean, in your time value of money accounts, especially in financial management and probably in math, you might have studied time value of money. You have to take the present value of the future earning power. Okay, PV factor. 1 year later, 95,000 means what is the today's value? What is the expected rate of interest you expect here? 10%. Okay, 1 year later, 95,000 means today's value should be present value of this. Present value means you have to divide this by or multiply with the present value factor, PV factor. What is the PV factor here? At the rate of 10%, 0.909 for the first year. Is that okay? So how will you calculate? 1 divided by 1.1. This is the P factor for the first year, second year, third year. That's how we learned all these things in time value of money. So the present value factor for 1 rupee by the end of first year is equal to 0.909 today. Second year end, 1 rupee is equal to 0.826 today and 0.751 by the end of third year. Okay, you multiply this cash inflow or profit, you multiply this, so you'll get the discounted cash inflow. I'll offer only the discounted worth, not the complete 95,000 as you demand. But rather than calculating these things independently, you can do a summation of these values. This is called annuity method. A stream of cash flows in the future, you have to bring that to the today's value by using present value of the stream, which is called annuity factor 2.486. What is the ultimate value here? 2 lakhs 36,170. This is nothing but the present value of the future cash flow. I will not pay 2 lakhs 85,000 because all this amount I am getting only by the end of first year, second year, third year, and interest component that will be eliminated after eliminating the net value today being only 2 lakhs 36,170. I will pay only 2 lakhs 36,170. You can study this along with the time value of money chapter. Okay, in simple, okay, your future maintainable profit or super profit as the case may be multiplied with the annuity factor. That's a formula. Like if you want to understand this as a formula, then the formula is simple. Any profit you expected to earn in the future, multiply with the annuity factor. That's called annuity method. But anyhow, the logic behind that is what amount I can generate in the future consisted of interest, so that interest component should be removed. That's called present value of all the cash flow streams is the goodwill. Clear? So we have completed all the 5 models: simple average price profit method, weighted average profit method, super profit method. Super profit method deals with the extra earning power only. In case of capitalization method, the capital required to earn this super profit will be goodwill. Under annuity method, I'm going to take the present value of the expected future profit. Expected future profit. Is that clear? All the 4 you might have studied in your school days, right? Except the anti method. Anti method, yeah, of course, not available at the school level. Now you can learn it easily along with the time value of money. I included question number 5, 3, and 4. These 2 questions for understanding a next level of goodwill calculations. Next level of goodwill calculation. If it is clear, text me. We'll move on to the next illustration. Question number 3. Now, next question. The profits of 20, 25, 5, 30 earned in these 4 years, 20, 20, 21, 21, 22, 22, 23, 23, 24. Your actual profit or the profit as per the book. I name this being book profit. The profit earned in the year 2021 being 20,000. Next year 25,000. Then 5,000. Finally 30,000. Finally 30,000. Clear? Hope now we'll be able to understand this one. Any doubts here? 20, 25, 5 and 30. Now, what usually we'll do, based on the previous year's profit, we can find out the estimated future profit, and by multiplying with the number of years we can expect this profit, we can get the goodwill easily. But in this illustration, the profit what we have calculated in the earlier years may be some error, maybe having some errors, or maybe having some special nature receipts and payment. For example, in the year 23-24, we have 30,000 profit, we assume. In the year 23-24, there is a special income maybe around 15,000 rupees, just like by luck you got. How can we expect the same in the next year? So, whatever the profit we earned in the previous year is the base to determine the future year's profits under simple average and weighted average provided here. Previous year's profit will be might have been earned because of some reason. Now the question is whether that reason will exist in the coming days or not. Whether that reason exists in the coming days or not. Clear? So during the COVID, all pass. We cannot expect the same this year also. If I decide based on your all pass result during the COVID, you are being the genius. How can I decide? You understand? The last year's profit will not reflect the future year. It means those things will be excluded. Similarly, some error may happen. That error will also be removed. After that, whatever the adjusted last year's profit you calculate now, that is the base for determining the future profit. This is first level of advanced problem at your preliminary level. First level of advanced problem. So whatever the 4 basic model you learned in your school days, apart from that, one extra model here you studied, which is called anti method. 5 models over. So where you just mugged up, it's goodwill is equal to 3 years purchase of 2 years average profit, whatever it may be. Simply multiply the average profit with the 3 to get the goodwill. That's how you learned. But now you learn the logics. Why do we calculate the average profits? The calculation of average profit is to estimate what is the future profit. And why do I multiply with the 2 or 3? Because to that years of to that year, we will have the expected means extra flavor with us, extra earnability with us, like the location advantage and key persons advantage, right? And while calculating the average profit, we take the previous year's profit, but if there is any error or there is any unusual income and expenses which may not happen in the future, then what you have to do? All those things are removed. So I'm going to remove all those unusual receipts and payment, unusual errors. Okay. Now, raw material purchased for 20 in 22-23 was debited to purchases. Sorry, plant and machinery purchased for 20 was debited to purchase account. In which year? 22-23. What happens here? There's an error. Tell me. Plant and machinery purchased should be debited to the plant and machinery account, but wrongly they have debited to which account? Purchases account. Wrongly. Come on, tell me what happens because of this one. Okay, in the year 22-23, this 20,000 rupees may not be debited in your P&L account. As it is, sorry, it's debited to the purchase account, it should not be debited. So you have to remove it. So 22-23, you have to remove it, means you have to add the 20,000 back. Otherwise, you can pass journal entry. What's the correct entry? Plant and machinery account debit to bank. value being 2020. What is the wrong entry? Purchase account debit to bank. Okay, purchase account debit to bank. Apart from that, what? Apart from that, rate of depreciation applicable for that being 10% on SLM method. So here depreciation account debit to plant and machinery, 10% being 2000. Now what about the rectification entry? Rectification entry. Tell me. While rectifying, bank has no trouble. Purchases should be reversed. Two purchases, 20,000. And in correct entry, plant and machinery debit credit ends with what? 18. And we have the depreciation also in the debit side 2. Clear? So plant and machinery account debit, depreciation account debit to purchase account is the rectification entry. And all these things happen not in the last year, last but 1 year, 2 years ago. So how can you rectify or pass the rectification entry if you are finding the errors after the preparation of final accounts? All the nominal accounts are replaced with what account? P&L adjustment account. So now this is nominal account replaced with P&L adjustment account. This nominal account replaced with P&L adjustment account. Then ultimate value being plant and machinery account debit to P&L adjustment account 1818. So here what happens? P&L account includes or increases by 18,000. 18,000. Apart from that, year 24-25, what happens here? As you're not debited to the plant and machinery, wrongly debited to the purchase account, in the next year balance sheet, it has no plant and machinery. If it has no plant and machinery, you may not depreciate in the next year. Only when there is an asset, you can claim the depreciation, but you don't have the assets in the year 24-25, you don't claim the depreciation. So here, omission is there. What omission is there? 10% depreciation on this asset under SLM method. So here, the entry being depreciation to plant and machinery. Amount being 2000. And also rectified after the preparation final account. So this will be replaced with nominal account 2000. So in the year 24-25, you have to subtract 2000 rupees because P&L account debited, it means the profit is reduced. Here P&L account credited, it means profit is increased. This is related to adjustment number 1, error related. So year 22-23, as per our book profit being 5,000, this is only after the error. This is only after the error. If the error is not done, then the proper profit and loss in 22-23 being inflated by 18,000 rupees. And then the profit and loss in 23-24 is decreased by 2,000 rupees. These are the two adjustments you have to make due to this particular one error. Clear? So I told you to study rectification of errors chapter in detail while studying the what? The basics of accounts. Okay, I asked you to study and put more importance for understanding the final accounts, NPO, single entry and all along with the rectification of errors, because in your further study you think that those things are for the preliminary study. No sir, those things are included as a single adjustment in your advanced study. Clear? Hope now you'll be able to understand. So you don't need to calculate in this much extent. If you are familiar, you can skip all these things. Okay. If you skip all these things, how can we calculate, sir? Very simple. Let's see. In this year, 18,000 wrongly debited, so you have to add 20,000 rupees. Because of the depreciation, you have not debited 2,000 rupees. Ultimately, 18,000. Next year, another 2,000. That's all. This is added, this is subtracted for the year 1 and year 2. That's very simple. What is the impact in the profit? 20,000 debited to the purchase, now removed. So 20,000 will be increased. And depreciation to be debited, that 2,000 will be adjusted. So only 18,000 is going to be included in the profit in the very first year. Next year for the depreciation, another 2,000 is subtracted. That's all very simple, right? You no need to work out all these things, but you need to have the knowledge of working completely as a structured manner. Then you can get the answer fast. Clear? Clear? Let's move on to the next one. The closing stock in 2021. See, the depreciation will have the impact for the up to the last year of your preparation or last year of requirement. Suppose if it happens in this first year itself, year on year you can claim the depreciation to be debited in the P&L account. But it happened only in 22-23. So we claim the depreciation for the 22-23 as well as 23-24 only. Here, closing stock in 2021 was undervalued by 2000. Second is related to the stock. Closing stock undervalued. If you undervalue closing stock, what happens? Usually closing stock shown in the credit side of the trading account. If the credit side is lesser, your profit is lesser. It means you have shown the profit lesser wrongly. Then what could be the correct profit? You have to inflate that profit. In which year? 2021. So increase this 2000 rupees. But don't forget to subtract this in the next year. Why? The closing stock of this year becomes the opening stock of the next year. In this year, this is being the closing stock undervalued, means profit might have been decreased in this year. Naturally, it becomes undervalued opening stock in the next year. The opening stock appears in the debit side. If you are showing the debit value lesser, GP is higher. So wrongly the GP is higher in the next year is now adjusted by reducing. Wrongly the GP is shown lesser in the current year 2021 is now inflated by 2000 rupees. We have now adjusted the stock. Third one, there was a fire accident and stock costing 4000 lost. Now tell me, 22-23 there's a loss of rupees 4000. Is it usual or unusual? So in the year 22-23 we lost, or our profit is very, very lesser due to a fire accident. If we ask you what happens, usually you score centum, but this time you score only 70. Sir, it was a heavy rain and I was caught up with fever and cold. I could not write the exams properly. You know, you are blaming the health issues and the natural calamity. Is that okay? The same happens here also. You can blame this 22-23's profit reduction due to the fire accident. You cannot expect the same fire accident the next year. So it's an unusual one. So unusual one should be removed. In the absence of fire accident, what could be the profit? You can increase the profit. So you add that 4000. You add the 4000. Clear? Abnormal loss is unusual. Abnormal loss or gain should be reversed. Existing manager drawing salary of rupees 3000 will leave from 1/4/24. Hence, the manager is recruited. A new manager is recruited for a salary of 5000 rupees. Now, what happens? Okay, until now we have a manager whom we pay only 3000. Hereafter, we are paying 4000, 5000 rupees. It means you are going to pay 2000 rupees additional salary for the future year. Now, what is the adjusted profit? Adjusted profit. Come on, tell me. Adjusted profit. First year 22,000. Second year 23,000. Third year 19,000. Am I sorry? How much? 518 plus 4. 27,000. And then 28,000. So find out the goodwill under 3 years purchase of 4 years simple average profit. Now find out the simple average. What is the total here? 1 lakh. Divide by 4. You will get simple average profit being 25,000 minus additional wages, additional salary you supposed to pay due to the new manager recruited. 25,000 is the expected future profit, but what happens here? Manager is changed. In old case, the manager was paid only 3,000. Hereafter, I have to pay 5,000 rupees. Additional payment of 2,000 rupees will reduce the future profit by 2,000 rupees. So if I subtract, then the simple average profit expected in the future being 23,000 as per simple average profit. Future maintainable profit as per simple average profit method. How many years you can expect this one? So 3 years. Then what about the goodwill? So goodwill is nothing but multiplication of these two. Then ultimate value being 69,000. Hope now you'll be able to understand this one. Okay, is it interesting, right? Which is more logically correct? This seems to be logically correct, right? Don't study for your exams or mark. Try to understand these things to be applied in your practical life. To be applied in your practical life. Something interesting, right? Are you learning something worth to be applied in your life? Hmm? Yes or no? Come on, tell me. Do you want to get the salary like others, or do you want to get the salary more than like others? Huh? Others getting salary 10,000 rupees. Do you want to get 10,000 rupees or 15,000 rupees? If you want to get 15,000 rupees, how can you prove that you are capable of earning another 5,000 rupees extra? What is the extra flavor you have? Experience, additional qualifications, and the skill what you have that others will not have. Clear? You can use this for entire life. If you are studying this for the mark, then of course it will not be useful at all. But enjoy learning this. Okay. Make it faster. Now let's move on to the next one. Now this is also one more logical illustration I coined here. Find out goodwill from the following details. Online students, come on, text me. Is it over? I'm waiting for you. Make it faster. So by the day after tomorrow and before by this weekend, you try to finish off the practice session. Okay, related to all these things. Okay. Do you have any holidays in this week? Government holidays? God, there should not be any holidays in this week. Your face says this message to me. Huh? Pujo holidays will be there, right? I think. Uh, we don't have any holidays in this month at all. Surprisingly. Okay. But anyhow, October 1 2, we have 2 days. Before Diwali, we have holidays, no problem. We'll try to finish up before Diwali, all the syllabus. Right. This question number 4 is one of the interesting question. The logic what I explained no is applied here. Find out the goodwill from the following details. The goodwill is due to locational advantage, patent, Mr. SSA, the key person. Because of these three reasons, the profit earnability being 10,000, 15,000, and 25,000. How will you calculate? Extra earning power into number of years that extra earning power will have. The extra earning power being 50,000 rupees, not due to single reason. This will be due to the three different reasons. But all the three different reasons will have totally different years of advantage. The location rental contract expires in 2 years. After the 2 years, we have to go for the new place. Definitely, we'll lose this extra earnability. So we build our business in Central Bus Stand. Immediately, Central Bus Stand shifted to some other village and the other country, isn't it? So what happens then? All the people who establish their business in Central Bus Stand will now collapse. I've seen a row of 20 taxis standing nearby the old bus stand now. It's not old Central, earlier Central, it's now old bus stand, 20. Earlier, whenever I was in need, I cannot find even single taxi. But all the taxi wallas there in road now. So what happens? Because of changing the location, you lose all the benefits. So you have only 2 years of experiencing this benefit. Thereafter, you don't have this benefit. So 10 into 2, 20,000. And patent expires in 4 years. Because of the patent, I'm able to earn 15,000 rupees excess, but I have only 4 years to enjoy this benefit. So 60,000 I can enjoy because of this reason. And key person retains in a matter of 2 years, so then I can enjoy 50,000 rupees. Then the goodwill in this case being 1,30,000. Is that clear? This question you cannot expect at your inter or foundation level, but you can understand the logics behind the calculation of goodwill here. Clear? Goodwill is nothing but earning power of the business, earning power due to some reasons, and the reasons will be for only few days, a few more years. So the earning due to the reason multiplied with the number of years that facilities will be with you, or that reason is with you. That is called goodwill. Clear? Now, let's start with accounting treatment. We have completed all these things. Now you will be able to understand all these logics. And we have completed all the 5 methods of calculation. Apart from that, future maintainable profit is nothing but adjusted previous year's average profit. Adjusted previous year average profit. Is that okay? It's not simply average profit. Adjusted previous year's average profit. Okay. Even this reason will have number of years. Usually you will multiply these two. Okay, number of years that these reasons, due to that only I'm earning extra money, you multiply these two, this is called goodwill. So we found out the goodwill. Now how are we going to account this? How are we going to account this in our books? Very simple, premium method. Okay. Now, in case of accounting treatment of goodwill, accounting, you need to have a working note and passage alert. The working note is nothing but raise the goodwill to all partners, old partners in the old ratio. It is nothing but crediting the partner's capital account and cancel the goodwill to all partners in the new ratio. Probably A, B, C being the new partner. Whatever the goodwill you calculated, will be shared to old partners first of all in the old ratio. Then later on, you reverse that by cancelling in new ratio to all the partners. So the ultimate value what you have for A and B being usually credit balances, and C will have debit balance. The person who has the balance in debit is called gainer. Because of admission, usually get some extra benefit hereafter, so he is being the gainer. Gainer should give some compensation, right? So C should give the compensation. To whom? To the partners who are losing. Who are the partners are going to be loser here? A and B are the losers, otherwise sacrificer. Sacrificer. So A and B are the sacrificer, give them credit, and C is the gainer due to the admission, so debit him. So the final answer being gaining partners capital account debited to the extent gain, sacrificing partners capital account credited to the extent sacrifice. This is what about the simple journal entry. Sometimes the gaining partner, says, don't charge me, sir, for the extent of gain I get. No, I may give in the form of cash. If it gives in the form of cash, directly debit the bank, which is usually brought in by gaining partner. Gaining partner. Is that clear? Clear? So if you are gaining, I'm charging you. If you are losing, I'm giving some benefit to you. So gaining partners debited, sacrificing partner is credited. Sometimes the gaining partner says, don't charge me, sir, I'll pay the money. Okay, you ask him, bring the money and taken by sacrificing partner. Later on, the sacrificing partners can withdraw the money brought in by gaining partner to their own home also possible. Then withdrawal entry may be passed. So the last component that you have to understand here, you have to understand the difference between goodwill and the premium for goodwill. These two are not same. These two are not same. For example, A, B, C are the partners. Their P&L ratio being 3:2:1, and the company's goodwill being, the firm's goodwill being 1,20,000. So the goodwill is 1,20,000 rupees. And if I ask you premium for goodwill, it is representing for one partner's share of goodwill only. For example, C. 1,20,000 is for the entire firm's goodwill. For the C's share could be, come on, 1,20,000, but C's share is only 1/6. So this value being 20,000. So goodwill is equivalent to the firm's worth. Premium for goodwill is nothing but the goodwill for one of the partners' worth. If one of the partners' goodwill only means the premium for goodwill is given, then you have to find out the goodwill first of all. After finding the goodwill, you can do this working note. So step number 1, cross check whether it's a goodwill or premium for goodwill. Step number 2, find out the goodwill and apply this one to find out who is the sacrificer or who is the gainer. Step number 3, pass a journal entry whether cash brought in or not. Maybe cash brought in, then bank account debited rather than gainer's partner's capital account. And if cash is not brought in, partner's capital account. If cash brought in, then bank account debited. Sometimes 50% or 60% cash brought in, balance is not brought in. Then bank, to the extent amount brought in, to the extent money not brought in, will be charged to the partner's capital account. These are the 3 simple steps you have to keep here. Clear? If it is clear, text me so that we will move on to the next illustrations for the accounting treatment of goodwill. Text me. So 3 steps. Check whether it's a goodwill or premium for goodwill. Second one is the working note to determine who is the gainer or loser. Third one is passing the entry. Now, we'll start with question number 5. Show the journal entry to adjust the goodwill on admission of the new partner C. The existing partners A and B share profits and losses in the ratio of 3:2. C is admitted for 1/5 share. So old ratio being 3:2, new ratio. Come on, find out the new ratio here. Let the profit be 1. Balance after C's share 4/5. This will be shared between A and B. So A's new share is equal to 4/5 multiplied by 3/5. So 12 by 5, 12 by 25. B case 4/5, out of that 2/5 will be for B, 8 by 25. In case of C, 1/5, to make the denominator equivalent to 25, you have to multiply denominator and numerator with 5, so 5 by 25. 5 by 25. The balance sheet is given, the goodwill of the firm being 25,000. C is not able to bring cash for his share of goodwill. So, no goodwill, no cash model. And for capital, he brings 40,000 rupees. For capital, he brings 40,000 rupees. Now, come on. Step number 1, we need to know the ratios. We got it. So, step number 1, whether we have been given goodwill or premium for goodwill. Cross check. So, we have been given goodwill only. Step number 2, what? Raise the goodwill to old partners in the old ratio. Rising means crediting to their capital account. Crediting to their capital account. So who are the partners? A, B, and C are the partners. This 25,000 should be raised using the old ratio 3:2. 15,000 for A and 10,000 for B. Nothing is for C. And don't forget to cancel the goodwill to all the partners in the new ratio to the all partners. All partners in the new ratio. New ratio being 12:8:5. This 25,000 should be shared among the 3 in the ratio of 12:8:5. 12,000 for A, 8,000 for B, and 5,000 for C. So A is credited with the 3,000, B is credited with the 2,000, C is debited with 5,000. From this, it is very clear who is the gainer. C is the gainer. C is the gainer. Now, she should bring the cash for 5,000 rupees. If she doesn't bring the cash for 5,000 rupees, C's capital is going to be debited. The third step, pass the entry. C's capital account debit. C's capital account debit 5,000 to A's capital to B's capital. 3,000, 2,000. See, already taught you the ratios. While teaching the ratios, incoming partner's share is given without further information regarding how it is sacrificed or gained from the other partners. Then it's a first type, where we'll start with a let the profit be 1 like we started, right? In this case, the old ratio is equivalent to sacrificing ratio of the old partners. It's a logic. You don't need to work out all these things. When, if it is being the first type, then incoming partner share is 1/5, you know, out of 25,000, incoming partners ratio being 1/5 means 5,000, and this will be shared among the 2 partners using the sacrificing ratio, which is equal to the old ratio. Just like that, you get the answer. 25 is the value in that 25,000, 1/5 C's value. Okay, 25,000 into 1/5. We got this. And this will be shared between these two using 3:2. What is that 3:2? No, it's not old ratio, it's sacrificing ratio. That's why I tell you. In this case, this is sacrificing ratio. Under this model, the old ratio is equal to sacrificing ratio. So some students will miss and learn that it may be old ratio. No, it's not old ratio, it's a sacrificing ratio. But old ratio is equal to sacrificing ratio in this case, so I applied the old ratio directly. You will get confused in some cases because in order to avoid that, so I give the steps. Go with the steps. You will not get confused. If you are master, then you will assume. Next part, he brings 40,000 rupees as capital. What is the entry for that? Bank account debit to C's capital. How much is that? 40,000, 40,000. Clear? Now we can incorporate these two journal entries in the balance sheet to find out the new balance sheet after the admission. Clear? Come on, tell me. C's capital debit, credit 40 ends with 35,000 balance here. Whose capital? C's capital. A's capital credited with another 3,000. So 70 becomes 73,000. B's capital includes another 2,000 rupees from the existing one, 62,000. Bank increases by 40 already. Current assets being a part of bank. The bank current assets consist of the bank. So 50 with that this 40 is added. So 90,000 will be the current assets. Rest of the two assets, fixed assets and current liabilities remains unchanged. Now come find out the total of balance sheet after the admission. I think it is 1,90,000. 1,90,000. Clear? Come on, make note of it. First question is over for the treatment of goodwill. Text me once it is over. Make it faster, make it faster. Now we'll move on to the next illustration. Keep the above illustration as it is, except that new partner C can bring his share of goodwill in cash apart from the capital. So now what happens, the same illustration. He brings cash. If cash is brought in, his capital account is not debited, so I name this being cash. Rest of the things are the same. Instead of 90, here it is 95,000. Here it is 95,000. This is 100,000. A's capital, the same 73. B's capital 62. C's capital being 40,000. And current liability is 20. All the things are the same, but 5,000 additionally included in the capital account as well as cash account. Clear? Not required to solve this. You can easily understand this. Now let's see. A and B are equal partners. C is coming as a new partner who pays 8,000 as premium for goodwill. The new profit sharing ratio among the partners being 4:3:2. So old ratio being 1:1, new ratio being 4:3:2. Now, step number 1, you have to check whether it's goodwill or premium. But here it is premium for goodwill. In case of premium, you have to find out the goodwill. This is the premium for incoming partners share only. Then goodwill is equivalent to 8,000 into incoming partner share is 2/9. 4:3:2 is nothing but 2/9. His share means 2/9 of the goodwill is equal to 8,000 rupees. Then what about the complete goodwill? 8,000 into 9/2 will be the complete goodwill. You can do the cross multiplication. So the goodwill in this case is 36,000. Past journal entries showing appropriation of premium money, assuming that the premium for goodwill is immediately withdrawn by the old partners. Money is brought in and withdrawn by the old partners immediately. Right. So what happens in this case? You need to work out separately what? Raise the goodwill to old partners in the old ratio, which is going to be credited. Cancel the goodwill to all the partners in the new ratio. A, B, C. 36,000 while rising, old ratio being 1:1, 18 for A and 18 for B. On cancelling, you have to use 4:3:2 new ratio. 16,000 for A, 12,000 for B, 8,000 for C. Now A is credited with 2,000, B is credited with 6,000, C is debited with 8,000 rupees. These two credit, this will be debit. So due entry being C's capital account debit to A's capital to B's capital. 8,000, 2,000, 6,000. But C brings cash for his share of goodwill. So rather than debiting this, I can debit bank account. Or you can pass two entries like cash account debit, C's capital account debit, and then pass the entry that amount is brought in by him. So in that case, the entry being cash account debit or bank account debit to C's capital. If we combine, then automatically name C is eliminated. Instead of that, we get the cash. And the premium for goodwill is immediately withdrawn by the old partners. Cash is brought in by the incoming partner, given to the old partners because they are being the sacrificers. As they are losing some benefit in the later, they are getting a compensation, which is the 2,000 and 6,000. The amount brought in by C is immediately they have taken it to their own home rather than invested in the business. So while withdrawing, the entry being A's capital account debit B's capital account debit to cash. To cash. 8,000, 2,000 and 6,000. Hope you will be now able to understand. Online students, come and respond me. If it is clear, text me so that we move on to the next illustration. I don't get any response from online. Make it faster. Yeah. A and B are partners in a firm sharing profits and losses in the ratio of 3:2. C is coming for 1/3 share, is to pay 30,000 as premium for goodwill. Again, premium for goodwill is given. Out of that, only he pays 15,000. Balance is not payable. As between A and B, they decided to share profits and losses equally. So old ratio being 3:2, 3:2, sorry. New ratio being 1:1:1. 1/3 is the incoming partners ratio. From the 1, if you subtract 1/3, 2/3 we have. 2/3 will be shared by A and B equally, means 1/3, 1/3. So 1/3, 1/3, 1/3. You can work out, you will get the same answer. Now check whether it's a goodwill or premium. Here we have been given premium. As we have been given the premium, we have to calculate the goodwill. 30,000 is the premium for goodwill, especially for the incoming partner C's share. 1/3 share is 30, means full share should be 3/1, 90. Now, step number 2, credit. Raise the goodwill to old partners in the old ratio. Who are they? A, B, C. Old ratio being 3:2. Yes, come on, tell me, what's the value? 3:2. 54,000, 36,000. And cancel the goodwill to all the partners in the new ratio. They are sharing all these things equally, 30, 30, 30. Then 24, 6, 30. These two are going to be credited, this is debited. So C's capital account debit to A's capital to B's capital. So here the value being 30, 24, 6. Out of the 30, 15,000 is brought in by C. So bank account debit to C's capital. Not full value, only a portion. 15,000 is brought in. 15,000 is brought in. Clear? So two more illustrations are there for reducing, for completing the treatment of goodwill. So after that, after the two illustration, we'll break and resume the class for admission after the break. Okay, finish off question number 9 and 10 along with me faster. Make it faster. Online students, come on, text me. A and B share profits and losses in the ratio of 3:2. They decided to share their future profits and losses in the ratio of 4:5. No admission, no retirement, but they want to change the ratios. Old ratio being 3:2 and new ratio being 4:5. So earlier A shares more, now B shares more. Maybe at the time of starting the business, A may be taking the responsibility of administrating. So he may demand around 3 share out of 5. Sometimes later A wants to retire or he wants to reduce his presence and B takes care of the business. So he demands more. Anyhow, the goodwill calculated up to the date of sharing, the change of the P&L ratio is due to the old partners in their old ratios only. No, they contributed the firm's growth based on their own old ratio of support 3:2. Then the calculation will be the same. Raise the goodwill to all the partners in the old ratio, means credit. We have A and B, two partners. This 45,000 should be shared between these two in the ratio of 3:2. 27,000 for A and 18,000 for B. Similarly, you can go for debiting. So reduce the goodwill to all partners in the new ratio. All partners in the new ratio. All partners in the new ratio. The new ratio being 4:5, 20,000 and 25,000. So A is the sacrificer. Because of that, he should be credited with 7,000. B is the gainer, so we have to debit him with 7,000 rupees. The journal entry being B's capital account debit, B's capital account debit to A's capital, the value being 7,000. Hope now you'll be able to understand. Pause the journal entry to adjust the goodwill to show the impact of change in profit and loss ratio. Clear? Text me. Question number 10 is one of the interesting illustrations. Okay. Now, this is for extra learning. I have not seen the illustrations in this aspect in most of the exams, right? Very rarely asked, but you need to understand the logics. That's why I included this illustration. A and B are equal partners. C is coming as a new partner who pays a share of premium for goodwill. The new profit sharing ratio among A, B, C being 4:3:2. Calculate the goodwill under 5 years purchase of 3 years simple average profit method and weighted average profit method for the period. So we have to follow two methods, simple average as well as weighted average. Okay. I follow only simple average method here. Come on, tell me. 9,000, 8,000, 10,000 divided by 3. How many years of purchase? 5 years of purchase. Then goodwill being 45,000. Raise the goodwill to old partners in the old ratio A, B, C. Credit their account. Cancel the goodwill to all partners in the new ratio. Should be debited. 45,000 should be raised to the old partners in the old ratio equal 22,500. 22,500. And under new ratio, you have to share it. Now 4:3:2. 5,000 per share, for 4 share 20,000, for 3 share 15, for 2 share 10,000. Then 2,500 A should be credited, 7,500 B should be credited, 10,000 C should be debited. Pass journal entry for goodwill. What is journal entry here? C, is he bringing the cash? New partner who pays, so he brings, so I can directly debit the cash or bank account to A's capital to B's capital. How much is that? 10,000 cash brought in by C, taken by A and B in their sacrificing ratio. If you find out the sacrificing ratio, that should be 1:3. Okay, that should be. Okay, 2,500, 7,500, you know. This ratio should be sacrificing 1:3. I can simplify this. You can calculate yourself. You will find the same answer. Now also find out past journal entry if the business is dissolved by the end of 2 years due to C's mismanagement. What about the case R? No entry. If it is lack of business order, the incoming partner C, the existing partners guaranteed that the business will run for 5 years. In 5 years, you will get so much money. That's what about goodwill. So 45,000 rupees external because the business will sustain for 5 years. But matter of 2 years, it's collapsed. So immediately the incoming partner demands, sir, you said that 5 years the business will give the money. So based on that, I pay around 10,000 rupees for the goodwill. But within 2 years, you've collapsed. So he demands, sir, out of the 10,000 rupees for the 2 years only business operated, for the 3 years not operated, 6,000 you have to refund. You have to refund. On investigation, it is found that this closure is due to the mismanagement of C only. C's mismanagement. The remaining 2 partners says the business is good enough and running smoothly because of your presence, your mess up. We closed the business, so we cannot do any justifiable refund. Clear? What happens if it is lack of business order? C says, sir, as per your expectation only, I joined. Matter of 2 years later, you say the business is collapsed due to the non-order. How can I know? You are pretty sure with the business because you are being the owner for a longer period. Kindly refund. Okay, I will refund. So now there's a chance to refund this 6,000. Under what ratio? The same ratio, 1:3 ratio. They have taken 1:3 ratio for the profit money brought in by C for the premium for goodwill. No, as per the terms, it should be for 5 years, but only 3 years. 2 years is expired. Another 3 years lost. For that 3 years goodwill you have to refund. So while refunding, A's capital account debit, B's capital account debit. 2, it should be refunded to C. C's capital. Finally, you make the payment. How much? 6,000. So 4,500 refunded by B and 1,500 refunded by A. Out of 2,500 for the 2 years, he enjoyed 2,000 rupees balance refunded. So 1,000 enjoyed balance refunded. Out of 7,500, he enjoyed 3,000 balance refunded. And now settle the money to C. C's capital account debit to bank. That's how you can finish up the payment also. Hope you will be now able to understand. Sometimes the goodwill may be refunded also. One of the interesting illustrations. One more interesting illustration is there. Partnership firm will have the goodwill. Incoming partner will bring the cash for or adjust in his own capital for the goodwill, right? One typical illustration where partnership firm has no goodwill, incoming partner has a goodwill. How can we value? We'll see in the next class. So along with the illustrations, right? We'll break and resume by. Now let's discuss the life policies, life insurance policies. Individual insurance policy, joint life policy. Firm takes a LIC policy on the partners with the insurance company. They could have taken insurance policy, probably LIC company like. Now, premium is payable. Premium is payable for all the partners independently. Assume that we have three partners X, Y, Z. X, Y, Z. Is that okay? Premium is payable. How? The premium is debited to the P&L account and paid. And independently it may be payable. Independently it may be payable. Premium as well as sum assured. So you have to understand the concept called premium, sum assured, and surrender value, and policy value. That sum assured will be otherwise named as policy value. If the policy value being 1 lakh, life being 10 years, then 10,000 will be considered as premium per annum. Premium per annum being 10,000. So the premium may be payable for X, Y, Z separately by debiting to the P&L account. Right. What happens, if any of the partners whose life is insured died, then what will you get? You'll get the sum assured. The sum assured may be the full value, probably 1 lakh will be hitting. But if you want to cancel the halfway through, death doesn't happen, but you want to cancel the policy halfway through, what happens? If you cancel halfway through, you don't get the sum assured, but only a portion of premium you paid will be receivable, which is called surrender value. Surrender value. Is that okay? So, in case of individual life insurance policy, you take the policy for every partner separately. Every partner separately by paying the premium. So here in this illustration, we have three partners, and premium may be payable for X separately, Y separately, Z separately. Partners share profits and losses in the ratio of 3:2:1, where Y died. If Y died, what happens then? You'll get the amount. So he died and others survive, then their policy will be cancelled on the date of death itself. For X and Z cancelled, as these two cancel, you can take the surrender value being 20 and 10. And Y died, because of that, you will get full policy value be refunded from the insurance company. As the premium debited, any claim you will get is also credited in the P&L account. What's the amount you will be receiving? 20 plus 60 plus 1 lakh, 1,80,000 rupees you will be receiving. To whom this 1,80,000 is given? To all the partners X, Y, Z in the P&L ratio 3:2:1. So X will get 90, Y will get 60, and Z will get 30. Hope you will be now able to understand. 90, 60, 30. 90, 60, 30. Any doubts here? So premium is payable by the firm, and any benefit from the insurance company is also for the firm. For the firm means it's shared by all the partners in their P&L ratio. If the policy is taken individually, even death of any partner, where we have to close all the policies. For the deceased partner's share, will get full sum assured. For the others cancelled, so you'll get the surrender value. That amount will be shared among all the three partners. Clear? Now, how much will you get now? 20, 60, and 10. Sorry, this is 10. Okay. What's the ultimate value? 90. Sorry, I made a mistake. You'll be getting only 90. Shared among the three in their P&L ratios of 45, 30, and 15. So on the date of death of Y, they will surrender the rest of the two and get the sum assured from Y. What's the overall value you will get for the insurance amount? Bank account debit to LIC policy. Amount receivable being 90. This is shared by XYZ, right? So X capital, Y capital, Z capital to bank. To bank or simply LIC. Life insurance policy. To life insurance policy. Later on, they can withdraw also. Clear? So 90 will be shared among the three. So 45, 30, and 50. So these are the two entries are passed in case of individual insurance policy. Individual insurance policy. Clear? Come on, text me. So you have to pass only these two entries. Entry 1, entry 2. For the deceased partner, you have to take the sum assured. For the continuing partner, you have to cancel their policy, you get the surrender value. Clear? Online students, respond me. Next, we'll move on to the JLP case. In case of JLP, Joint Life Insurance Policy, JLP. Okay. LIC company, partnership firm. They'll pay the premium by debiting to the P&L account. Okay. In the P&L account. The one thing is here, for all the three partners put together, a common premium is payable. It's not for X separately, Y separately, and Z separately, it's collectively. Okay. In this case, even death of one of the partners, probably out of three partners, Z died. What will you get? You'll get the sum assured directly. Sum assured directly. You don't get the sum assured directly, you don't get the surrender value. There is only two options. There are only two options. One is surrender, another one is claim. If Z died and you will get the sum assured, rather than Z died, if the firm is cancelled or dissolved, then the JLP is cancelled, then you'll get sum assured. Sorry, surrender value. Then you'll get surrender value. Because you cannot cancel one and claim for the maturity amount for the other. That's not possible. It's a joint life policy. Even death of one partner is sufficient to get the full value. If you want to cancel, you have to cancel completely. Only these two will be possible. In this case, this amount, sum assured or surrender value, will be transferred to the credit side of the P&L account, ultimately transferred to the whole partners in the whole ratio. Okay. Now here you have to understand three methods of passing the journal entries as well as preparing the ledgers possible. So we'll start one after one here. You'll get either sum assured or surrender value. But in individual, we get sum assured as well as surrender value. For these two, surrender value. For this, it is sum assured. Because individual life policy. Here it's a joint life policy. Death of even one partner is sufficient to get the full value. Or if you want to cancel, you get full value at the rate of surrender value. Is that okay? Now, X, Y, Z are partners sharing profits and losses in the ratio of 2:1. On 1st January 2021, they took out joint life policy 1 lakh. Joint life policy for rupees 1 lakh. Annual premium being 5,000. Starts with 1st January 21 and payable every 1st January 5,000 rupees. This is premium. Okay. So first premium being 21, the premium being 5,000 every year. Last premium was paid on this date, means 1/1/22, 1/1/23, 1/1/24. He might have paid 5,000 rupees premium on every 1st of January. Every 1st of January. Is that okay? And why died on this date? 1/3/24. So automatically you get the sum assured. And policy money was received on this date. What is this policy money? You'll get 1 lakh rupees. Even death of one partner is sufficient to get the full value. The surrender value of policy on 31st December every year, being first year end, this year nil. Okay. Premium being the year beginning, and this will be end. First year nil. Second year 1,000. 23 end 2,500. 24 end, meanwhile, as death happened, you'll get the sum assured back. Show necessary accounts and balance sheet as on 31st December each year, assuming that premium is charged to the profit and loss every year. Means premium method. Premium expenses method. We now pass the journal entry as well as prepare the accounts, ledger accounts and all for this. Come on, tell me. What about the journal entry here? On 1/1/21, here premium is going to be debited to P&L account, and sum assured or surrender value, as the case may be, credited to P&L account. This is the first process. What is journal entry for this 5,000? Joint life policy premium account debit to bank on which date? 1/1/21, 5,000 rupees. Year end, this being the expenses transferable to the P&L account. So the journal entry being 31st March 21, 31st December 21. P&L account debit to JLP premium 5,000 rupees. 5,000. Next, again the same way, 1122 JLP account debit to bank, JLP premium account debit to bank. You paid 5,000. Year end, transfer that to the P&L account. P&L account debit to JLP premium 5,000. JLP premium 5,000. Is that clear? Then again, on this 1123 JLP premium account debit to bank 5,000, 5,000, and P&L account debit to JLP premium 5,000, 5,000. Again on 1124 JLP premium account debit to bank 5,000, 5,000, P&L account debit to JLP. See here, before the year end, what happens? There's a one more collection on this date. 31st January, March 24, you'll get the collection. So here the entry being bank account debit to JLP premium account. This value being 100,000. So up to the earlier year, 31st December 23, all the JLP paid is cancelled by transferring to P&L account. In the year 24, JLP premium debit 5,000, credit 90,000, so 1 lakh. 95,000 balance is there in JLP premium. No, can be transferable to the P&L account. From there, it will be ultimately transferable to the owners, partners. So directly transfer to the partners. So JLP premium account debit or JLP account debit to partners are X, Y, Z. Okay, X capital, Y capital, and Z capital. This entire 1 lakh should be shared among the three partners in the ratio of 2:1. So 95,000 should be shared among the three. Come on, how much is that value? 38,000, am I right? 38, 38, and 19. Hope now you'll be able to understand this one. Also, you have to prepare what? Ledger account and how this will appear in the balance sheet also parallelly. Now, ledger account. So, we have to open the JLP account. In case of JLP, year beginning we have how much? 1121 to bank. $5,000. Year end, transfer to the P&L account. Closed. Year 2, 1122 to bank. 5,000. Year end, transfer to the P&L account by P&L account, 5,000. Year 3, one bank, 5,000. Year end, 31st March 24, by bank 1 lakh. By bank 1 lakh. Is that okay? By tallying whatever the balance you have, transferable to the partner's capital account. On 31st March 24, it is transferable to XYZ. 38,000, 38,000, 19,000. Hope now you'll be able to understand this one. Clear? JLP account balance. 5,000 rupees is in the debit side, 1 lakh rupees in the credit side. Net value being 95,000. Balancing figure. Every year that 5,000 premium paid is debited to the P&L account. The last year JLP premium 5,000 is there in debit, not debited to the P&L account because P&L account not prepared. Meanwhile, we got another 1 lakh rupees. So debit 5,000, credit 1 lakh, ends with 95,000 balancing figure. 95,000 being the balancing figure. Clear? In the very first year, we have the 5,000 in the debit, 5,000 in credit gets closed. Zero balance, zero balance, zero balance. In the last year, 5,000 in the debit, 1 lakh in the credit, ends with 95,000 balancing figure. That's transferable to the partners. Apart from that, you may be asked to prepare the P&L account also, how this will appears in the P&L account. You can prepare the P&L abstract. P&L account abstract. Here, for the year 21 to JLP for the year 2021, 5,000 rupees. For the year 2022, JLP 5,000 rupees. The premium paid is debited to the P&L account, right? For the year 2023, the amount debited to the P&L account here being 5,000 rupees. 2024, we don't have any amount to be debited. What about the amount appearing in the balance sheet? Nothing will appear. Premium paid is expenses debited to the P&L account. Sum assured received on maturity will be your income credited to the partner's capital account. That's all. So nothing will be shown in the balance sheet. This is model number 1. 3 methods are there. This is the first method. So premium is the expenses debit to the P&L account. Sum assured or surrender value, what you get is your revenue credit to the partner's capital account. Or credit to the P&L account. From there, it will go to the partner's capital account only. Logic is very simple. Premium is debited to the P&L account. Sum assured or surrender value is credited to the P&L account. First, in the next situation, every year to the extent of surrender value will be considered as an asset. You paid 5,000 rupees, worth is nil. So all the 5,000 being considered as expended, lost. Okay. What about the expenses? 5,000 is the expenses. In the year 2, you paid 5,000 rupees. Now the value is 1,000 only. Otherwise, in total, you paid 10,000. If you surrender by the second year, you will get only 1,000. So 9,000 is the expenses for the 2 years put together. Very first year already, we consider 5,000 being the loss, another 4,000 being the expenses in the second year. You understand? You have to take the cumulative value. You paid 10,000 rupees and cumulative value being only 1,000. So you have to compare this one. In the third year, you paid 15,000 rupees. If I surrender by the end of third year, you will get only 2,500. 15 minus 2,500, 12,500 is the overall loss. Up to now, 9,000 was already adjusted. Still, how much we have lost in this year? 3,500. The expenses extent is going to be debited to the P&L account to the value we have for the surrender will be considered as even asset. This is the next method. Premium paid to the extent lost will be considered as an expense debited. Premium value to the extent if we get recovered in case of surrender will be your asset. So rest of the things are the same. You can prepare the ledgers as usual. Come on, make it faster. Now, JLP premium minus surrender value will be considered as expenses debited to the P&L account to the extent of surrender value is considered as asset. Now start with the first year. 1121 premium paid account debit to bank, JLP premium to bank 5,000 rupees. By the end of first year, how much is lost? Entire 5,000 lost, debit to the P&L account. 31st December 21. P&L account debit to JLP premium. JLP premium. JLP premium. And 1122 JLP premium paid being 5,000 to bank 5,000. 5,000. How much is lost now? 4,000. For the 2 years, 5 plus 5, 10,000 we paid. After the end of 2 years, if I surrender, I will get only 1,000. So over the 2 years payment of being 10,000, I lost 9,000 rupees. Already I consider 4,000, 5,000 being the loss and debited to the P&L account of the previous year. The current year loss being another 4,000. Our current year expenses being another 4,000 debited to the P&L account. P&L account debit to JLP premium. The value being 4,000. The value being 4,000. And next year, 1123. Again, I paid 5,000 rupees JLP premium to bank. This value being how much? JLP premium to bank 5,000 rupees. How much I lose now? Debited to the P&L account. P&L account debit to JLP premium. How much is that? 3,500. For the 3 years, I made a payment of 15,000 rupees for the premium. Out of that, the third year end, if I surrender, I'll get only 2,500. So 12,500 is the loss. This 12,500 loss, already I charged 5,000 to the P&L account, another 4,000 debited to the P&L account, balance 3,500 to be debited in this year's P&L account. Now we'll move on to the last year, where 1123, 1124, sorry. I paid the premium being 5,000 rupees, JLP premium, 5,000 rupees to bank. Now on 31st March, how much I get? How much I get? Bank account debit to JLP. I get 1 lakh. I get 1 lakh. Once I get the surrender value, thereafter you no need to maintain JLP account. You can close the entire JLP account. Any benefit you have or balance you have in JLP, transfer over to the partners in their own P&L ratio. Okay. JLP account debit to X capital, to Y's capital, to Z's capital. Clear? JLP. How much is the balance? Come on, tell me. What's the balance in JLP? Hmm? What's the balance? 90? 92 find. So under this model, this 92 find, you can cross verify. 5,000, 5,000 cancel 0, JLP balance. 5,000, but only 4,000 is charged, so 1,000 balance is there. Here 3,500 charged, 1,500 balance, already 1,000 balance is there, so 2,500 is the balance, which is the surrender value. Out of the 2,500, I am adding 1 lakh, 1 lakh 2,500, JLP being 2,500. In JLP, we have the balancing figure 2,500. With that 5,000, you add and subtract 1 lakh, so you get only 92,500. 2,500 is the balancing figure of JLP by the end of 2023. Again, you paid another 5, you realized 100. So 92,500 should be transferable to all the 3 partners in their P&L ratio 2:2:1. Come on, get me the value. 30? 37,000, 37,000, 18,500. Also, you can prepare the ledger account for JLP as well as P&L account and balance sheet. How this will appear in the balance sheet. All these things are going to be prepared. Now, JLP. The very first year, to bank, 5,000, and year end 31st December 21 by P&L account 5,000. We don't have any balance for the first year end. In the second year end, 1122 to bank 5,000. Here on 31st December 22 by P&L account 4,000. Okay, balance carried on being 1,000. To the extent of surrender value appears as a balance. And the next year 1123 to balance brought down 1,000. In the year 23, again to bank, the value being 5,000. And here should be charged to the P&L account 31st December 23 by P&L account 3,500. The overall value being 6,000, 3,500 is subtracted, balance 2,500. Balance carried on. Balance carried on. 1124 to balance brought down 2,500. In the last year, again we get a payment for JLP, another 5,000 rupees to bank. And here on 31st March 24, you get the collection for the JLP by bank, the value being 1 lakh. The balancing figure in this case being 92,500 shared among the partners. Shared among the partners. Okay. X, Y, Z. Shared among the partners X, Y, Z. 37,500 for X, 37,500 for Y, 18,500 for Z. We got this value. How this will parallelly appear in P&L account as well as in balance sheet. Let's see. In P&L account, here for the year 2021, okay, 37,000. Okay, this is 37,000. Okay. In 2021, JLP paid being 5,000 debited. 2021, JLP paid being 5,000. 2023, JLP paid for life of partners 5,000 rupees over. In balance sheet for the year 2021, we don't have any asset. Okay, we don't have any balance. We have the balances only in these 2 years. To the extent of surrender value will be considered as an asset. So 2022, JLP 1,000 surrender value will be your asset. 2023, JLP will be considered as your asset, which is 2,500. Again, 2024, we don't have any asset. We don't have any assets. In the very first year, we don't have the surrender value, so no asset. In the last year, we closed everything. We don't have the surrender value or any asset. But year 22 and 23, we have two assets. One is all about the surrender, means that is equivalent to the surrender value. Clear? Hope now you'll be able to understand this one. Let's move on to the next one. Third option. We are creating a reserve or provision. This expenses can be debited to the provisions like so. 3 entries will be there for every year. Okay. Like a provision for doubtful debts is created. The provision for doubtful debts is used to adjust the bad debt like here. So we create the joint life policy reserve and any expenses during the year is debited to the reserve. That's all. The rest will be the same like. Okay. Shall I move on to the last one? Come on, text me. The last option. Online students, come on, respond me. So the last case, premium is debited to JLP account as usual. The sum equal to premium debited is now JLP reserve, otherwise JLP reserve method. JLP reserve method. Let's see here. Now, JLP created, JLPR created, and JLP expenses leaving the surrender value debited to JLPR created. Okay. Step number 1, pay the JLP expenses. Step number 2, create the JLPR. Step number 3, adjust the JLP expenses by debiting to the JLPR. 3 entries. 3 entries. Right. Let's start with this one. Let's start with this one. Now, first on this date 1/1/21, JLP account debit to bank. How much is that? 5,000. What's the next entry? Creating the JLPR. How can you create? By debiting to the P&L account. How do you create the provision for doubtful debts? By debiting the P&L account, you create the PDD, right? P&L account debit to provision for doubtful debts. Similarly, P&L account debit to JLP reserve account is created. Once the bad debt comes, that the bad debt is now charged to the JLP. Means provision for doubtful debts. Like so, here second entry JLPR created in the year end 31st December 21. P&L account debit to JLPR account. The value being 5,000. Now tell me, out of the GLP, how much is the worth today? Nil. All the amount what you paid is considered as expenses only. We don't get even single penny as well reserve as under value. So everything is lost. Then the JLP expenses is now debited to where? JLPR account. So the journal entry being JLPR account debit to JLP account. Value being 5,000. Repeat the same for the next year. Repeat the same for the next year. The entry remains same. 1/1/20. So I just write as it is. It's only repetition. So the change will be only here. 22, 22. Second year also you paid 5,000 rupees. You created the JLPR 5,000 rupees. But today it's worth rupees 1,000. Out of 5,000, today's worth being 1,000. So how much is lost? 4,000. The amount lost will be now adjusted here. Now you have the JLP as well as JLPR 1,000 each. In JLP 5,000, 4,000 adjusted. So 1,000 JLP you will have. JLPR 5,000, 4,000 adjusted. Still you have JLPR 1,000. So 1,000 each for JLP as well as JLPR by this year end. By this year end. Okay. Now we'll go for the last year 23. 23. What happens here? How much is the expenses? 3,500 is the expenses. To the extent of amount lost will be now cancelled by transferring the JLP to JLPR 3,500, 3,500. Okay. What about the balance in JLP as well as JLPR by the third year end? 2,500. 2,500 will be the balance in JLP as well as JLPR. Here 1,000, here 2,500 because another 1,500 is increased. So we are creating the JLPR and the loss for the payment of JLP is transferred to the JLPR. The balance will be available in JLPR as well as JLP. JLPR and JLPR account. JLP is an asset. JLPR is a reserve for adjusting loss in case of asset. Then finally, final year 1/1/24 JLP account debit to bank. How much is the payment? 5,000. And halfway through you will be getting around 1 lakh rupees. Bank account debit when? On 31st March 24 itself will get money. Bank account debit to JLP 1 lakh. 1 lakh. Clear? Now we have to close the JLP and JLPR both. Before closing that, we'll open the concerned ledger to find out what is the balance in JLP and JLPR, so that thereafter closing will be very comfortable. So now I'm going to open JLP and JLPR account. Now JLP, JLPR account for the year 21, 1121 to bank, to bank. The value being 5,000. The value being 5,000. And in JLPR, on the same year end, 31st December 21, P&L account debit to JLPR by P&L account 5,000. And by the year end, we knew that JLP has no worth. The entire JLP payment of 5,000 is worthless, can be debited to the P&L account. But here, to debit this, we have created a new reserve called JLPR, so we can directly credit it. So here, 31/12/21, you can transfer this to JLPR account. In JLPR account on 31/12/21, JLP account, 5,000 rupees. Now the first year is closed. We don't have any balance. We don't have any balance. Repeat this for the second year. Second year, 1122, 1122, bank. Make the payment of rupees 5,000. Make the payment of 5,000 rupees. Create the JLPR in the year end, 31st December 22. Okay, P&L account, 5,000 rupees. Second year, we made a payment of 5,000 rupees, created JLPR. Now, what's the worth of this 5,000? By the end of second year, if I surrender, I'll get only 1,000 rupees additionally as a surrender value. So, only 1,000 is the value. Balance 4,000 lost. To the extent value lost is charged to the JLPR account. So, here, 31st December 22, the loss amount is transferred to the JLPR account. Usually, you transfer to the P&L account. Here, we created a JLPR meant for adjusting this loss. So, I transferred to the JLPR here, the value being 4,000. The value being 4,000. Now, in JLPR 31/12/22, JLP account 4,000 rupees. After this, you get the balance. How much is the balance? 1,000 is the balance. Balance carried on. Becomes balance for the next year. 1,000. And here, balance being 1,000. So from this, it is very clear that JLP as well as JLPR will have equal value in the balance sheet. JLPR appears in the liability side and JLP appears in the asset side. Clear? Hope now you'll be able to understand this one. Next. Next, we'll go for the year 23, the last year. We made a payment for JLP, bank, value being 5,000. By the same time, you are creating JLPR 5,000 rupees, and 3,500 is lost. So that loss is transferred to the JLP to JLPR for adjusting. 31st December 23. JLPR 3,500. 31st December 23. JLP 3,500. Now ends with the balance now being 2,500. As already told you, under this model, JLP as well as JLPR will have equal values. Equal values. 6,000, 6,000, 2,500. Balance carried on. 1124 balance brought down. Balance brought down. 2,500. Here 1124 balance brought down. Balance brought down. Okay. 2,500. In the last year, I get the JLP paid, expenses paid, bank 5,000 rupees. And I recover JLP also 1 lakh rupees. 131,324 bank. We recovered how much? 1 lakh rupees. See, any amount we lost due to the payment of JLP is charged to the JLPR account, right? If there is an expenses debited to the JLPR, if the JLPR not required further, transfer to the JLP account itself directly. We no need to have this anymore. Okay, that's the logic. So we have multiple approaches here. Right. In this last case, in text I have worked out this way: 1 lakh, 1 lakh. I have 92,500 balance can be transferable to the JLPR. Until earlier we have the negative charge to the JLPR. Now we have positive also transferred to the JLPR account. So 92,500 transfer from JLP. So you finish up tallying this 95,000. Hereafter the balance available in JLPR no more required can be transferable to the partners XYZ. So by transferring this, come on, tell me, what's the ratio? 2:2:1, 38, 38, 19. Hope you will be now able to understand the last model also. JLP and JLPR. How this will appear in the P&L account and balance sheet. In the P&L account as well as in the balance sheet year on year. First year we create the JLPR, year 2021. We create the JLPR by debiting to the P&L account. So here, okay, JLPR account, 5,000 rupees. Second year, also JLPR created, year 2022. JLPR, the value being 5,000. 2023, again we created the JLPR 5,000 rupees. That's all. How this will appear in the balance sheet? In the very first year, 2021, we don't have any balance. In the year 2022, JLP as well as JLPR. JLP has 1,000, the same amount will be available in JLPR also. The value in JLPR shown in the liability side, the value in JLP shown in the asset side. 2023, Same way JLP and JLPR. JLPR. Here this value being 2500. 2500. And 2024, we don't have any balance. Only these 2 years we have the balances. Usually the JLP and JLP are appearing at its own surrender value extent year after year until it is surrendered or claimed for fully. Hope you will be able to now understand the three methods of accounting for JLP and the logics of individual life insurance policies also. The content what I have covered related to the JLP, no, in your examination point of view, you may expect 2 marks or 1 mark questions only, not beyond that. So you need to understand the logic. No need to work additional sums, only these sums are enough. So for the practice, you need to have 50 or 100 sums also only for the comprehensive illustration. That's we are going to discuss here, right? That's very, very important. So I have broken down all the logics behind whatever the adjustments may be for the comprehensive calculations up to now. Is that clear? If it is clear, text me so that we'll move on to a comprehensive illustrations. Reconstitution of partnership firm or admission. In case of admission, so what are the things to be incorporated? Okay, what are the things to be incorporated? One second.